Episode 2, The End of Gold and the Beginning of Forex. Welcome to a new episode of the series Crown and Throne of Currencies. In this episode, we are diving into one of the most important revolutions in financial markets and exploring how, after Nixon's historic decision to end the dollar's convertibility into gold, the world moved away from an old system and entered the era of the global Forex market. First, let me point out something very important. Contrary to popular belief, the Forex market is not a newborn market created by the internet. Currency exchange has always existed, but what we call now the modern Forex market really began to take shape in the 1970s, right when countries gradually moved away from the fixed exchange rates of the Bretton Woods system and shifted toward floating rates. So how did the story unfold? After the Nixon shock, the global monetary system entered a period of instability. Before that, many currencies were pegged to the US dollar and the dollar itself was tied to gold. Once that link was cut, the illusion of stability began to collapse. This is where a key realization emerged. Countries that understood that keeping exchange rates fixed like before was no longer possible. So step by step, they moved toward floating exchange rates, meaning currency values would now be determined by supply and demand. Of course, this didn't happen overnight. The world entered a transition period, one where countries still tried to maintain fixed rates, but in reality, the old system could no longer be relied upon. According to the German Central Bank, by March 1, 1973, the fixed rate system had effectively reached its final phase. Very quickly, Bretton Woods collapsed in practice, and the floating rate system became the new reality. Now the question was, if exchange rates are floating, where should currency prices be determined? Naturally in the market, but not a market accessible to everyone. This is where phase 1 of Forex began. At first, the game was entirely controlled by banks and governments. In the early 1970s, the currency market was mostly an interbank market between major banks, central banks, and multinational corporations with real commercial needs. Most trades were conducted over the phone through voice brokers and in extremely large volumes. Here's an interesting point. Almost at the same time that exchange rates began to float, new financial instruments started to emerge. In 1972, the International Monetary Market was launched in Chicago, introducing currency futures trading for the first time. Currencies were traded in a standardized futures markets. This matters because it shows the world was already preparing itself for a new era of currency volatility. As this evolution continued, one of the biggest turning points in Forex history occurred. Trading gradually moved from the telephone to terminals and screens. In 1973, Reuters launched a major service called the Reuters Monitor Money Rates Service, often described as the first electronic marketplace for Forex and money market rates. According to Reuters' own records, the service went live on June 25, 1973 in London, initially with only about 30 clients. From that point on, prices became visible faster, decisions were made quicker, and the market began to go digital, although banks were still the dominant players. With technological progress, Reuters trading systems entered a new phase. In the 1990s, Reuters Dealing 2002 introduced around 1992 enabled electronic matching. This meant buy and sell orders were matched automatically by the system itself, based on the best available prices rather than by humans. After this stage, banks reached a crucial conclusion. The future of Forex was all about networks and infrastructure. Whoever controlled the trading systems essentially controlled the pulse of the market. This realization triggered infrastructure competition among banks. In this environment, EBS entered the game, an electronic platform created by major banks to compete with Reuters and make interbank trading faster and more transparent. So up to this point, we've seen how the old system collapsed, exchange rates were freed, banks and major institutions became the main players, and electronic platforms moved Forex from phone calls to screens. But one big question still remains. When did ordinary people enter the game? The entry of retail traders into Forex did not happen overnight. It was a gradual process, driven mainly by the rise of the internet, brokers, and online trading platforms. Forex began to seriously grow for retail traders in the late 1990s and early 2000s, when broad public access to the market became possible for the first time. While some wealthy or professional individuals had access before, true mass participation began when everything became simpler. When exchange rates became available online and brokers offered smaller accounts, people could trade with just a computer, without calling a bank. That's when Forex slowly transformed from an exclusive market into one that ordinary people could not enter. Now, another key question arises. When gold was removed from the equation and exchange rates became floating, what replaced gold as the backing of money? The answer is clear: politics, economics, and trust. From that point on, currencies no longer had the stability they once had. A political crisis, a policy decision, or even a war could impact currency values. And this is exactly what makes Forex so fascinating. Forex isn't just charts and candles. It's real-time reflection of what's happening in the world. Now, let's imagine for a moment. What if gold had never been removed from the monetary system? What if exchange rates had remained fixed and the modern currency market had never formed? If the world had stayed on the Bretton Woods systems, the global economy might have been more stable but much slower. Countries wouldn't have had today's freedom to conduct monetary policy, economic growth would have been more limited, and every major crisis would have ended in gold shortages and massive pressures on the system. In reality, with the scale of global trade and capital flows today, a fully gold-backed system would have been almost impossible to sustain. Either global growth would have stalled or the system would have eventually collapsed. And it was this structural dead end that changed the course of the global economy, ultimately leading to the creation of the market we now know as Forex. But one very exciting part of the story still remains. Now that the global currency market has formed, how did new powers enter the game? Who began challenging the dollar? And why do some say that the real war started right here? In the next episode, we'll dive straight into these questions. So make sure to subscribe, hit the notification bell so you don't miss it, and let me know in the comments, did Forex really give freedom to traders, or is it still a playground for the world's biggest powers?